Welcome to our February 2026 quarterly macro and markets update featuring our Chief Investment Officer, Michael Dow. I am Julien Frazeau, Deputy Chief Investment Officer here at Beacon Pointe, and I have the pleasure of serving as your host and moderator for today's discussion. We have a packed agenda as usual, so before we dive in, just a few housekeeping items. We have set 90 minutes for today's session, and we have more than 100 slides and a broad range of topics to cover. So we'll move at a steady pace. Many of you have submitted excellent questions in advance. Thank you. We also encourage you to submit questions during the session using the Q&A box at the bottom of your Zoom screen. Michael will address as many as possible throughout the presentation. We also have our colleague Nick Coletta on the call, and he will respond in a chat to highly specific or technical questions as they arise. A full recording of today's webinar will be available within 24 hours at beaconpointe.com/videos, so you can revisit any part of the conversation at your convenience. To guide our conversation this morning, we'll focus on 4 key themes shaping the macro and market environment as we move further into 2026. First, we will start with the big picture backdrop, a busy start of the year, and an update look at where we are in the business cycle. From there, we'll step back and focus on the longer-term secular forces at play, contrasting the structural headwinds of the 3Ds, debt, demographics, and deglobalization, with the transformative momentum of AI. We'll take a closer look at one of the defining stories of the market cycle, the AI gold rush, and ask whether we are witnessing the early stage of a lasting opportunity or signs of a bubble. Next, we'll shift to the cyclical outlook, with the Federal Reserve firmly in focus alongside the evolving dynamics of the US consumer and what continues to be a K-shaped economy. And finally, we'll conclude with what all of this means for investors, basically, discussing portfolio positioning for 2026 with a particular emphasis on the role of alternative investments. With that, let's get started, and please join me in welcoming our Chief Investment Officer, Michael Dow. Thank you.
Julien, thank you very much. And a big shout out to Nick Coletta, who's on the call with us, for his work in helping us to prepare for today's presentation. Julien mentioned we have a packed agenda, as we always do, so let's jump right in. It has been a very busy start to 2026. January was quite chock full of news for the market to digest. But first, as we always do, I want to take a step back from the news cycle and remind folks what's really important when thinking about how and where to position portfolios and what's important in investing. And the most important things are the 4 boxes on top. That is, let's figure out where we are in the economic business cycle and what the inflation dynamics are. This leads you to what the Fed is likely to do in terms of raising or lowering interest rates. Also, by determining where you are in the business cycle, you can get a sense of where corporate profits are headed. So the combination of corporate profits and what the Fed's doing can give you a sense of what the intrinsic value or the fundamental level of the equity market should be. Now, then you have to decide where to invest. And if all of the available information is already incorporated into the level of the equity market, that means the valuation is full, so you wouldn't want to necessarily add to risk. If the level isn't supported by or the valuations are stretched, you might want to reduce risk. If the valuations appear to be trading cheap, then you might want to add to risk. So this is the framework that we always start with, because everything else is just noise out there. So first and foremost, where are we in the business cycle? The answer is, while we have been in what we would call the late stages of the business cycle for many quarters now, you would expect that at some point that would no longer persist. So are we going to break out to the upside? Are we going to have a reacceleration, or are we going to have a slowdown or potentially a recession? And the answer is, at least from our perspective, all signs are pointing to resilience here in the late stage of the business cycle. So it's an interesting time, and we're going to address many of the aspects of why we think we're in a resilient component of the late cycle and that we're not necessarily going to break to the downside, at least for the next couple of quarters. Where do we stand with inflation? Inflation remains elevated slightly now. Interest rates are almost normalized. Monetary policy then would be near neutral. And in fact, because we're getting more information to suggest that inflation might be persistent, and we're going to get more data on this tomorrow. We have a CPI release unusually on a Friday, and we had a labor market report yesterday on a Wednesday. That's flipped, but that's what we got because of some data issues related to the government shutdown and other factors. But the Fed is going to be on pause because they need to see more data to suggest that inflation is moving more decisively towards their 2% target. And given the new Fed chairman, who will likely be approved by the Senate during the nomination process, but not guaranteed, there's some aspects of the current administration and in Congress that we're going to have to talk about whether or not Kevin Warsh is going to sail through the Senate and get approved to be the next Fed chair to replace Jay Powell in May. But he's had some thoughts in the past about balance sheet management and using that in conjunction or maybe in lieu of interest rate changes. We'll talk about what that means for investing later in the presentation. And unless we get a real significant economic slowdown, profits, especially in the tech-related fields, appears incredibly resilient. So you'll hear me say the word resilient or resiliency many times, I think, over the course of the next hour. So just be prepared. That is the name of our cyclical outlook. We believe that we're in the late stages of the business cycle, but that there is evidence to suggest that we will remain resilient, at least for the next couple of quarters. And finally, when deciding where to place money, valuations in some areas, particularly in growth-related stocks or the NASDAQ writ large, appears maybe stretched, maybe not. The whole thing about valuations is you have to determine if corporate profits are growing fast enough. And in many cases, particularly for some of the AI-related, either big tech or hyperscalers, and we'll address this again later in the presentation, it does look like the growth rate of their earnings might just justify some of these lofty valuation levels that we're seeing. So with that, let's jump right in. First things first, I want to take a step back from the US and go to the 30,000 foot level and say just what exactly the global environment is doing. That is, we're looking at the JP Morgan Global Purchasing Manager Indices, a great indicator of global economic activity. Here on the left chart, split between global services and global manufacturing. Anytime you see a number above 50, that means global services or global manufacturing are expanding. And in the current environment, both are. On the right, you see these global PMIs broken down, not just the top chart here, the top line of the chart, which is labeled global, is a representation of these two series. And this is the breakdown by country. So you've got developed markets, emerging markets, all looking pretty, kind of yellowy. No, not a lot of areas to be concerned about, except for maybe India seems to be slowing down and maybe Spain. But here in the U.S., it's pretty much, business as usual. I wouldn't even call it muddle along. I'd call it resilient. There's the word again. You'll hear it again. So global composite activity seems like it's on track to be supportive, broadly speaking, of global growth. What is one of the reasons why this is possible or why it's happening? And the answer is because we've seen a lot of rate cuts coming out of emerging market central banks and out of developed market central banks, although the pace of rate cuts in developed markets seems to be flattening. In fact, in the last 3 months, there was actually 4 rate hikes across the developed markets and 3 rate cuts, so pretty evenly matched. However, looking back over the last 12 months in the developed markets, you only had 7 total rate hikes. 4 of them came in the last 3 months, but you had 64 rate cuts. So what I want to suggest here is that the policy environment, particularly monetary policy environment, is quite accommodative across the globe. The global rate cutting cycle is decelerating in the US. There's probably some room to go in EM, but it's all very supportive of the global economic environment, and that's been reflected in the PMIs we saw on the prior chart. Let's take a look at 2026 year-to-date market performance. So you've got a stock market here in the US that's up 2%, and the ACWI or All Country World Index, ex the US, so everybody else, is up 6%. This is a continuation of what we saw in 2025 when foreign stocks significantly outperformed US stocks. Part of that has to do with a slide we'll get to in a sec, which is that there's been some significant depreciation of the US dollar. So here in interest rates, we're looking at stocks on the left. You've got interest rates here. They're pretty flat. There's not a lot of movement here year to date, although today there's another move lower in yields, reflecting, I think, a rotation out of the equity market and into bonds. Obviously, buying more bonds causes yields to decline, but we're in for a little bit of I would say a reassessment of the growth, not the growth outlook, but the equity market valuation levels, especially across, I would say, software, and big tech seems to be taking the brunt of it. And volatility, we had two vol spikes in January, both related, I would say, to geopolitics and/or trade. But we're back to sort of normal levels here. And in terms of looking at oil and other commodities like Bitcoin, is the beatdown continues in Bitcoin. Tough fourth quarter. Year to date, we're down 20%. Whereas oil and oil's up 12. It was flat or down in 2025, but we've seen a bit of a recovery in oil, probably related to geopolitical tension in Iran. If there was a supply disruption because of any kind of an incursion into Iran, oil prices are going to go up. Probably not a lot, but a little bit anyway. That might be feeding into the oil price increase. But in terms of gold was up 50% last year, and it's up another 17% this year. All of there's another slide I want to get to that'll dig more deeper into this whole gold or currency substitutes issue. So what have we got here? This is gold price going back to 2010 on the left, and just a 1 year gold price chart here. You can see literally a doubling of gold prices from $2,600 to $5,400. Then we had Kevin Warsh was the nomination of the president to become the next Fed chair, and he was viewed as hawkish. And hawkish means that he's likely to be a little more vigilant about inflation, maybe more so than the administration would like. And his nomination actually caused the US dollar to rally, which the alternative then is gold to sell off. So that's what this dip is here in the first part of, at the end of January, during the first part of this year. But as it stands, looking at a moving average, 250 period moving average of gold prices, this is just a logarithmic. You never see this, very rarely does a move like this end well. It almost always reverses at least a significant component. I'm just going to highlight historically, when things move up geometrically or logarithmically, they tend to come down pretty quickly too. We're not calling for that right now because there does seem to be some good secular reasons why the US dollar might be challenged going forward. So here's the US dollar. It's down 10% or 12% now from the local peak, and going all the way back to 2022 when the Fed started raising interest rates. By the way, raising interest rates, very good for the US dollar, because when interest rates are higher here in the United States, it encourages capital flows to move from other countries to a more desirable rate of return here in the United States. And you would expect, as the Fed began rate hiking in March of 2022, that the dollar would rally, and it did. Now, you've had some choppiness since then, and then since the inauguration and election day, the dollar rallied again, as you would expect, given tariff implications that generally causes the dollar to rally. But then there was a surprising and significant decline during what was a chaotic policy implementation period in the first half of the year, which, given the uncertainty around the desirability of owning US dollar denominated assets, when you're threatening trade policy, tariffs, et cetera, and you're implementing them in a way that's hard to forecast or manage, it generally is one of those things where you sell first and ask questions later. And a lot of US dollar denominated assets got sold in the first half of 2025, causing this 11% downturn. And then we had a bit of a rally and a bit of a downturn. But right now we're hovering at levels not seen since 2021 on the US dollar. So interest rate differentials matter, policy and trade balances matter, but there's a lot of cross currents. And our view is it's likely that the dollar will remain under at least a little bit of pressure throughout 2026. One of the other things that causes money to flow, I talked about interest rate differentials. As interest rates in other countries that are investable, that are viewed as hard currency, That would include Japanese JGBs or Japanese government bonds. Japanese yen is a hard currency. The euro in the Eurozone is a hard currency. Pound sterling and potentially Swiss francs are also hard currencies. But JGB yields or Japanese government bond yields have seen a really significant increase in the last 2 or 3 years from very low levels, near zero until 2023. And then you've got this pretty significant upturn. That's causing money to flow out of other assets and back to the Japanese bond market and Japanese equity market, and causing the Japanese yen to rally, which causes the US dollar to decline. Julian, did you have a question that you wanted to ask?
Yeah, just a question, really previewing the next slide. I guess we're in an election year, and I guess clients are wondering what it means, if there's any implication in terms of returns you can expect in election years versus non-election years.
Short answer, there's a lot of other things that go into equity market returns. We talked about them on the very first slide. I don't see Fed policy, corporate profits, or where we are in the business cycle necessarily being directly influenced by what year we are in the presidency, specifically the second year when you have the midterms. In the midterm, you generally see a loss of seats for the incumbent party. If you have a Republican in the White House, Republicans generally lose seats, up to 30 seats in the House and 2 to 3 seats in the Senate. That's the averages. But again, every situation is different. So here's the numbers if you're looking at them. The first year of a presidential or during a presidential election year, you generally see a return of 10.5%. During the midterm year, which is the second year, you see a more lackluster return of 7%. This is just the historical data, but I want to caution folks that there's nothing scientific about this data. It is an artifact. It's empirical. You can go find it. I'm not sure it tells us how to manage the money, though. But since 1929, these are the results. Speaking of dollar substitutes, let's just take a look at Bitcoin price on the left and Bitcoin volatility on the right. You've seen a pretty precipitous fall in Bitcoin price from its record high back in October of last year at 125,000. We're back down to 67,000. As I think the way to view Bitcoin is not as a currency substitute, although sometimes it gets thrown into that bucket. Bitcoin is really more of a risk asset. And if the Fed was going to continue to lower interest rates, if there was a major risk on happening, and there's certain areas of the market, particularly high beta areas. I think the way to think about Bitcoin is a high beta stock. It's just going to continue to follow liquidity, which means the Fed. And if the Fed is done lowering rates, it's probably not good for Bitcoin and other high beta risk assets. If the Fed restarts a rate cut cycle or moves more decisively lower for good reasons, then you'd like to think that Bitcoin would see a floor and rally. But the point I want to make about Bitcoin to include it in an investment portfolio is very challenging, in large part because of these volatility spikes and these long extended periods of time where the price goes up 100% and then down 50, up 100, down 50. Now, if you did that continuously, you'd be pretty happy. But there's so much vol in it that makes it a difficult thing to include in an asset allocation. But it has had a pretty rough ride and a long, ride downward now here, down almost half since the peak. And it's important to note. Along with the re-rating or the downward trajectory of Bitcoin prices are other high beta assets. In this case, what wasn't a high beta asset historically, but it's become a high beta asset, and that's the software stock. So everyone's talking about how a basket of software stocks, which includes these names here, including CrowdStrike, Snowflake, a number of others at AppLovin, Okta, Monday, etc. All of these go into an equally weighted basket that we're following. And after being up almost 8 times back 3 years ago in January of 2023, these stocks had a very significant run up, but it paired back to now only a 4-bagger, now only up 400%, which, by the way, there's a lot of volatility here. But if you owned a basket of software stocks, you'd still be pretty happy. But most investors have a tendency to focus on this drop as opposed to taking a step back and looking at the long term and seeing what the overall gain is. As I said, if you'd invested in a basket of these stocks back in January 2023, you'd be up 400%. That would be a good, triple on what the S&P, the broader market has done. So all in all, a pretty good deal. What's causing the most recent, what we're calling SaaS apocalypse? I'm not calling it that. A lot of commentators are calling SaaS apocalypse. SaaS is software as a service, and it's an industry that, again, these names and these equities represent. And what you're seeing here is a lot of anxiety about the potential for AI to contribute to maybe these companies not just not doing very well going forward because much of what can be done in a computer programming environment might be replaced by an AI model such as Claude Code or something like that. Nick, did you want to jump in here on this AI thing?
Yeah, I was just going to ask you if you thought that this was a bit overdone or whether that this was completely justified.
Almost impossible to tell. Generally, when you have significant sell-offs, there is a baby out with the bathwater component to it. But AI is a generational, a transformative technology. Making bets on individual stocks, or even in this case, a broader basket's better, but trying to pick which one of these stocks is going to be the winner or the loser 3 years from now, it's really, really challenging. It's even hard for the hyperscalers and some of the big cap tech, Microsoft, Amazon, Apple, Nvidia, Tesla, and others, to see if they're going to be around in the same. It would be impossible, I would think, to be able to predict with any degree of confidence that one of these either software stock basket candidates or the hyperscalers, they're not going to be the same companies 5 years from now that they are today. That's how rapidly things are changing, particularly the software companies. So how do you want to play this? And our answer has almost always been what we're looking at in terms of AI is it being a way to augment many of the functions that are already out there. So and we'll talk about this in much more detail later in the presentation, but think about AI and the benefits of AI being dispersed more broadly across the economy. You're going to get access to the benefits of AI at a much less risky, not as high a return for sure, but with much less volatility, much less what I would call risk of ruin by placing all your bets on one or two software stocks. That's not prudent because you don't know what you don't know about what's going on underneath the hood at some of these companies, and you don't know what's coming down the pike in terms of the next big technology, or you don't know which industries are going to be affected positively and negatively. There's some assessment of that. And Joe Davis at Vanguard has done a lot of work on this in terms of identifying tasks, not jobs, and what can be automated, what can be augmented. And it's on that framework and on that basis that you can look at not just industries, but very specific job titles and say these are going to be most affected by AI or these are going to be less affected. You'll see that chart coming up. Nick prepared a nice one for that. Going to quickly try to just see what's happening year to date in the currency substitutes. I want to highlight the fact that back in 2025, which is the red bars here, this is 2023, 2024, 2025, and 2026. You've got silver, US dollar, gold, and then Bitcoin on the right. Important to highlight, silver had a bang up year in 2025 and doing very well so far year to date in 2026. Same with gold, up 60. This scale is just so so large. You've got 150% gain here, 60% gain here. Gold is up again 17% year to date. Not surprisingly, with these commodities up where they are, the U.S. dollar is down. And Bitcoin, you can see here, if you own Bitcoin in 2023, you don't really care about this 7% loss in 2025 or a 20% downdraft in 2026 because you were up 300% in 2023 and 130% in 2024. Julian, did you have a question?
Yeah, I guess it's the right time to ask that one that comes back every quarter. What's our view on gold? And then what's our view on the US dollar? Is it better to have a weak or strong dollar? And implications?
Better depends on who you are, better or worse. If you're an international equity investor, a lower dollar is beneficial. If you're an exporter of goods here in the US, a lower dollar is beneficial. There is a natural tendency to strength in the US dollar because of our reserve currency status, which perpetuates demand for dollars for both reserves in other central banks. They want to own US dollar assets to manage their own currency volatility, and in international trade and transactions, which are in many cases, in almost all cases, denominated in US dollars, although that share is declining. That also supports the US dollar. So what I would say about views on the US dollar factor into our portfolio construction process to the extent that it influences whether we want to be overweight or underweight international stocks versus US. And we are. We have been overweight international during a period when the US dollar was declining and international equities significantly outperformed the US throughout 2025. We're still overweight international equities. And we still believe the US dollar is likely to be under pressure. We're less overweight international because once you've had a pretty significant rally, it's prudent to sometimes take some chips off the table. So that's what we did in January in our rebalance. As it relates to gold, I would say this. Everybody loves gold when it's up 50%, but it doesn't have any earnings. It doesn't have a yield. So gold just sits there until you have substantial geopolitical risk or real interest rates in the US go negative. That is, if you look at gold versus interest-bearing securities like bonds, if the real yield on bonds is negative, gold looks more attractive. If there's geopolitical tensions, Venezuela, Iran, Ukraine, Russia, potentially Taiwan, all of these things contribute to the safe haven demand for gold, which is a lot of the reason why it's had a pretty stellar couple of years. But I want to make an important point. You don't need every single asset in the portfolio that in hindsight was up 50 or 100% in the portfolio. It's not necessary to achieve the objectives of your investment policy statement if you're institutional, or to achieve the objectives of your financial plan if you're a private client. This is a really important point. We're solving for an equation that may or may not include gold. And if it does include gold, it's a very teeny tiny amount, because trying to assess where gold is going is a very difficult thing to do. And the definition of an investor is, I have an information advantage that can allow me to say with a high degree of confidence that gold is trading rich, cheap, or fair. Let me repeat that. An investor needs to have an information advantage to determine whether to invest in a particular asset class. And I'm of the mind, and it has been my experience in my career, and our investment committee's view, that getting an information advantage on gold is incredibly difficult. And furthermore, back to my first point, it's not necessary to have gold in your portfolio to achieve your objectives. We're solving for an equation that includes public market assets, equities and bonds. That's the main component. Those two returns, the returns of public equities and public bonds, determines and your portfolio's performance against that benchmark of public equities and public bonds. That's what determines whether you achieve your objectives or not. So very important to note, gold has had a stellar year. Sometimes Bitcoin has stellar years. It's not necessary to incorporate them except for a small portion of your, what I would call, mad money. But from an investor's perspective, we can't get an information advantage on either one of those assets, so they won't be a significant part of a portfolio at Beacon Point at this stage. Really quickly, just want to touch base on the ACWI, which is the Global Equity Index, and the AG, which is the U.S. Bond Market Index. It's the combination of those two, public equities and public bonds, in compositions of 50-50, 60-40, or 70-30. These are the returns that matters. And anybody that has a diversified portfolio of stocks, bonds, and alternatives is likely to have achieved some kind of results over the last 3 years, 2023, 24, and 25, plus year to date. It's been a pretty good period already, year to date through Feb 11. You've got some pretty nice returns here in the purple. But look at these 3-year returns for a 60-40, 15.5, 11, 16.3. If you were a little bit more, you had a little more risk tolerance, you were in a 70-30, 70% equity, 30% bonds. You were up 17, 12, and 18% over the last 3 years in a diversified portfolio of stocks and bonds. Incredibly potent numbers. Very rare to get 3 great years like that in a row. ACWI, the global bond index, was up 20%, 18, 22% last 3 years, and it's already up 4%. If you annualize that 4%, you'd be up, 30% again this year. That's not likely to happen, but everything is firing here on equity markets. They're doing very well. So keep it in mind. Part of that is because we're not headed to a recession anytime soon. That's this chart here. Julian, did you have a follow-up on that?
Just to correct the global equity index, you said bond.
Oh, I'm sorry. ACWI is the global equity index. Apologies. ACWI means all country world index. It's our benchmark for global equities. The AG is the US equity benchmark that we look at to say, here's what the market's offering for global equities. Here's what the market's offering for global bonds. Thank you, Julian. This is a pretty good chart. This is GDP from the first quarter of 2025 when you had this massive, what I would call import. You're trying to get ahead of the front. You're trying to front load imports ahead of tariffs in the first quarter after or during the period when the president was inaugurated in January. So during that quarter, you had a massive push to get all the stuff you wanted into the U.S. before tariffs took hold in the second quarter. That was supposed to cause a significant slowdown. We were talking about stagflation potentially as a result of tariffs. Tariffs increased prices to consumers, and because of the uncertainty of how they were rolled out, could have caused a dampening of economic growth. Didn't happen. In fact, you had an acceleration. This is a bounce back period right here. This is an acceleration. We don't have the number yet. We'll get the next report on February 20th. For a fourth quarter GDP to see what that's like. But the expectations are for a bounce back in the second and third quarters of 2025, and then a slowdown to the potential trend growth of the US, which is about 2%. This is a very sanguine looking forecast. I can think of a number of different figures that might show up here, given some exogenous shock we're not aware of, a stock market reversal, a geopolitical event, whatever, that might take GDP down or up. But to produce the blue chip economists' expectations of smash packed right on top of potential trend growth throughout 2026, it certainly promotes our cyclical outlook of continued late cycle resiliency. There's no scope for in this forecast for a recession. And there's no scope for a reacceleration that would cause the Fed some angst about maybe raising rates. In fact, these are the numbers we just saw for GDP on the bigger chart just prior. But I wanted to incorporate inflation and the Fed funds forecast here as well. Inflation remains elevated, stalled above the Fed's 2% target, which means the Fed is likely to kind of remain on hold. There's a 1 or maybe 2. This was produced February 9th. Before the labor market report yesterday, which showed a much higher than expected increase in non-farm payrolls. That took the next expected Fed rate cut, moved it from expected to be in June to now July. Not a big move, but because there was such strength in the labor market, the biggest non-farm payroll number in a year at plus 130,000, taking the unemployment rate from 4.4 down to 4.3, it looks like that's going to be enough to either just push out a Fed rate cut, be one more month at least. There's a meeting in June and a meeting in July. It doesn't make a lot of difference at which one they cut rates. But the more they push it out, the less likely it actually happens. And for all of 2026, it looks like the market's pricing in 2 rate cuts, which would take us down to something on the order of an R star of 3.25. R star is definitely not 4.25. We would be very accommodative right now, because we sit at 3.75 is the upper. So the outlook for Fed rate cuts is 1 or 2, and that's what we're seeing here. Pretty much a Goldilocks outcome. You've got trend growth, inflation elevated, but that's okay if you're trying to get rid of your debt mountain, and we are. Higher inflation is very good for debt dynamics if you're looking at it from a sovereign perspective. So a little bit of elevated inflation, that's probably good. and the Fed moving more towards their normalized rate. What does it all mean? Are we going to have a recession? Well, it was about a 40% chance right after and during Liberation Day, when we were during this period of what I would call peak policy uncertainty. The good news is policy uncertainty has a tendency to dampen economic activity, but I think we're past the peak of that. I don't think we're going back to an environment where every single day you wake up and there's a new either executive order or a policy pronouncement or a reversal of a policy pronouncement. It's that up and down and being kind of yo-yoed on a policy perspective that causes CFOs and treasurers and CEOs to stop hiring, to stop buying. Policy uncertainty generally is a dampener of economic growth. It didn't happen in the surprisingly, very surprisingly, did not happen in the second and third quarters of 2025. And it looks like the likelihood of a recession has declined even further because we do think we're past peak policy uncertainty. And there's a fair amount of what I would call fiscal tailwinds. There's a lot coming down the pike in the form of tax refunds, accelerated depreciation to promote business fixed investment. The tax refunds will keep the consumer happy and spending. So there's a lot of fiscal stimulus, not so much in terms of monetary policy. In fact, some would say, and in conversations with some Fed officials, this was borne out. The effects of monetary policy in 2026 are likely to be less than they have been in the past because most of the big moves have already been made. It's really fiscal policy that's going to drive the economic engine for the coming year. I always like to look at some heat maps. We disaggregate our forward-looking outlook for the economy into things like inventory, leading economic indicators, probably the more important financial conditions. Very important to look at financial conditions. Financial conditions are simply the cost of funding of the U.S. economy. With financial conditions easy, it's easy to hire, make investments, et cetera. So financial conditions tend to lead GDP by 4 to 6 quarters. So easy financial conditions is a very good sign for third and fourth quarter GDP growth of next year. The thing that you want to highlight here maybe is consumer sentiment has been absolutely crushed for much of the last year. And this is contributing with easy financial conditions. One of the financial conditions you're looking at is the level of the S&P 500. So you've got stock market up, but most consumers are feeling down. That's the essence of a K-shaped economy that we'll see a little more detail going forward. Not a big signal here. This is taking all of these data series and turning it into a Z-score and trying to make some judgments about what the aggregate macro indicators and time series are telling you. The answer is there's not a strong signal. They've recovered a little bit, but not a strong signal. This simply tells you that financial conditions are easy. Our Z-score on financial conditions is moving upward, whereas the sentiment, which is the orange, and inventory factor, which is green, are actually kind of in the negative. It's really sentiment I'd like to focus on there. It's a bit of a tug of war between financial conditions, which will almost always win out because they have a broader impact on the economy, versus what might be a large group but have narrow impact on GDP, and that is the folks that are not that don't own substantial equity market exposure, that don't own homes that have risen dramatically. So we're talking about a K-shaped economy between asset owners and folks that don't have as many assets. And that's the K-shaped, and it's the folks that don't have many assets that aren't participating in the recent rallies that are looking at the world and feeling a little down, and in fact, in many cases, depressed. We're at very low levels of consumer confidence. In terms of the labor market, we did get a print yesterday. I just wanted to highlight the surprising strength in the labor report from yesterday. You got 130,000 new jobs with 65,000 estimated. The unemployment rate's down to 4.3, was at 4.4. And this is the number of this is the number of jobs added since 2020. So they're off the chart in the COVID period because there's a massive amount of fluctuations here in COVID. But there's a clear trend here. The 6-month moving average here is clearly trending down, and the unemployment rate's clearly trending up. But it's very gentle. It's not a spiking of the unemployment rate. If you get a spike of the unemployment rate and don't give the economy a chance to adjust, you generally get a recession. But this is it bears watching, but it's not flashing red. It might be flashing a little bit of yellow here, the labor market. There were cracks that were appearing a couple of months ago when you had some significant negative non-farm payroll numbers, but the labor supply is down as well. That's why the unemployment rate is not rising. Labor supply is down. That's the denominator. Whereas demand is quite volatile with the data issue. So we're looking at the labor market data with a bit of a grain of salt and waiting to see if the trends are being borne out. The Fed is also focusing almost exclusively here on the labor market. They want to make sure that they can, if there's a way to support the labor market with additional Fed rate cuts and the inflation data allows them to do it, then they will restart rate cuts. Just a little more detail here on our heat map. Job availability and those that are unemployed for more than 27 weeks are kind of flashing red here. But in terms of average aggregate weekly hours are increasing, and it does look like if you can't get a full-time job, that a temporary services unemployment is actually supporting the labor market. But this is a mixed bag. There's some good, some bad, which is why we say it's it's flashing yellow, but not red. And again, Nick has been able to convert all of our time series from the labor market into something that does indicate a bit of weakening in terms of where we stand in the 6-month moving average of the labor market diffusion index, anything print below 50. So this is why the Fed is remaining vigilant, is many of the labor market data series do indicate the potential for maybe support might be needed in the future. Quick look at inflation. Okay, Rob asked a question about labor supply. All of it is due to the crackdown on immigration. There's two components of the labor market that you need to be aware of: native-born workers and immigration. Native-born workers, that number is actually declining or has declined because of demographic issues, whereas immigration has been a long time input. And it's, in fact, while, and again, depending on how you look at immigration, to me, it's no matter how you increase the labor force, that's generally good for GDP. So it's likely to have some influences beyond, the most recent change in the immigration dynamics. But certainly one thing we can say that's not controversial is with less labor market supply and less labor market demand, the unemployment rate is not likely to move dramatically because you're affecting both the denominator and the numerator. And ultimately, and we'll get to this in a sec, GDP is labor force growth plus productivity growth. Labor force growth plus the change in productivity equals GDP. So unambiguously, it's a tautology. For whatever reason, if the labor market's declining, it's likely to mean the potential speed limit of the US is declining too. Let's look at inflation real quick. So you've got two measures of inflation, an intermediate and a long-term. The long-term inflation expectation measure here is your best expectation of Fed credibility, by the way. These numbers and the short-term 5-year break-even, the 5-year break-even has spiked pretty dramatically, but this has a lot of a pretty strong beta and correlation to oil prices, the short-term inflation number. But that's a pretty nice, not nice, it's a pretty big move from 2.25 to up 25 bips, and it hovers around 2.5. The Fed will take notice of this when they're deciding whether to lower interest rates. I think they would have a hard time lowering interest rates if this short-term inflation number is above 2.5. This one, not so bad. I mean, the long-term average for these two series are here, 2 and 2.07. That's the Fed's targets, obviously. Those numbers are quite on top of the Fed's expected long-term target. So 2.34, it's flashing yellow, not red. And again, more data on the inflation components, heat map. Mostly services are doing very well, whereas goods and food and energy, those prices are challenged, whereas many service prices, particularly now shelter, is showing some pretty significant positive moves downward. Transportation, so airfares and things, and education and communication. Those are moving lower. Most people, if you're going to the grocery store, though, you're not seeing much benefit yet, and that might be a significant issue during the campaign. Quickly, inflation heat map, diffusion index. Again, not a strong signal here, although if you were to take one away, it might actually be that Inflation hasn't gone away. These are taking the diffusion index. It's not highly volatile, but it's volatile. So we take a 6-month moving average, and it's right on the expansion contraction line. So not a lot of information there, and there's not a ton of information to be gleaned from the disaggregation of the inflation data series into goods, services, food, and energy at this point. If you're looking to get a signal for where inflation is headed in the future, a very good data series and one that has a kind of a 1 to 2 year lag is to look at what's called the crude intermediate PPI. Crude doesn't mean oil. It means not fancy or not smooth. Crude is a very, I don't want to say unscientific, but it's crude in the sense that it is not defined. But here's the data. The data for the intermediate PPI is volatile, fluctuates, but CPI, which is on the right-hand scale here, you can see there's a lead here. Whereas if you're looking at the blue series, the PPI or the producer price index, those are input prices as opposed to CPI, which is what you see on the shelves. The inputs obviously input price increases have a lead to final prices. And you can see here there's pretty strong correlation. What are we seeing in terms of the shorter term data? It looks like PPI is pushing lower, so that might actually be positive for a Fed rate cut. Want to talk just briefly about the upcoming election and what might be the big stories through between now and November 3rd. Again, you generally lose seats if you have a Republican or a Democrat in the House, in the White House. Then the Republicans or the Democrats, respectively, often lose seats in the House of Representatives. So that's just those are the facts. These are the things that are likely to influence the outcome of the election. If these numbers could compress, that is, if the job approval increases overall for the president, it will improve the probability and increase the chances of the Republican Party retaining control of Congress. And then for the agenda and some of the policies that have been promoted by the administration can continue to be pursued. If you have a change in government, that is, if you have a mixed right now we have a unified government. Republicans control the House, the Senate, and the White House. If you get a mixed government where the Democrats control one of those houses, then the policy agenda is not likely to be affected. That's it. So you're probably done and maybe lame duck for 2 years. That's always the way it happens, almost invariably. And these are the metrics that are going to determine, in my view, who's going to control Congress. You got to look at the economy and inflation, and the approval ratings for the president have to compress here. Right now, the disapproval on how to handle the economy has gone up pretty dramatically, and disapproval on inflation. I think affordability and inflation are going to be the big ones. Of course, whether you're a Republican or a Democrat matters. Independence, this is the key. I think this is probably the most important chart to follow, and it has to do with who's going to actually determine the outcome of the election. Back in a year ago, there was very little difference in independence, whether you approved or disapproved. But now it looks like many independents are disapproving of the president's job. Julian, did you have a question?
No, I just wanted to say time flies when you're having fun, and we still have 2/3 of the book to cover. So let's talk about our secular outlook.
I think that's where we're headed. Our secular outlook, it reflects these tailwinds and headwinds, and the headwinds are known. We understand with a high degree of precision what the debt levels are and how they affect economic growth. Higher debt, lower growth. Demographics. I talked about how labor market growth is a significant or a specific component of GDP growth, of a driver of GDP growth, and we'll see that on the next chart. Demographics are challenging, especially as it relates to birth rates here in the U.S. and immigration. Those two things will impact the speed limit of the U.S. economy or the potential growth rate. Deglobalization. We're pulling inward in terms of the supply chains. And that's going to increase costs, and increased costs have a dampening effect on economic growth too. So there's 3 very well understood headwinds to the U.S. economy, and they're known. The big unknown that could be the savior of the economy is AI and the productivity enhancements that can be gained. And here's the numbers. So total factor productivity changes in the 50s, 60s, 70s, 80s, 90s, and then for the first half of the 2020s here. Orange is total factor productivity change. Blue is labor input, so it's the change in the labor force. So the average GDP in the 50s was 4.3, real GDP growth, 4.4 in the 60s. And then it started to decline, even though we had a boom, a baby boom here in the 70s. We had a baby boom. Less so, well, the baby boom was in the 50s, post-World War II. These are entering the labor force now in the 70s, those folks. Then you had a productivity quick boom here. And then we kind of had a bit of a, not quite secular stagnation because total factor productivity was high, but labor input changes in labor, the labor force fell off a cliff here. Most of these, maybe this boom here also includes females re-entering the labor force. So once that growth started to tail off, by the time you hit 2000 to 2009, the increase in the labor force was significantly detracting from potential GDP. So here's where we are now. We're starting to see a bit of a bump up in labor and total factor productivity, but a drop off in immigration and hence changes in the labor force. So here's what I want to say about that. It is literally a battle and a weighing and measuring machine. If the productivity gains, total factor productivity gains from AI can outweigh the demographic challenges that we face here in the United States, much less so than China, Europe, but more so than Latin America, for example. Our demographics are challenged, but they're not flashing red. They're just kind of yellow, whereas China and Europe are red. And it's green in the emerging markets, particularly in Latin America demographics. But the point here in the US is challenged, but we also have this, and we're one of the only countries or regions that has can place significant hope in the AI basket. But this is why we care. AI is going to generate productivity gains. You add that to an offsetting a declining labor force participation rate or increase in the labor force, and that's what you get. But AI has got, you got to think about jobs, but really it's more about tasks. So what kind of jobs that have tasks that can be augmented or automated? And this is a scale. This is from Joe Davis's book, Coming into View. He published it last May. We're actually going to have him on site in the end of this month at our Beacon Point conference down in Dana Point. That's internal. But I'll be doing a fireside chat with Joe, and we're going to talk a lot about his views on what kinds of jobs. I mean, I've got 3 kids in their 20s and one in the 30s, young 30s. This is important. What should they be looking at in light of AI? One of my kids is a computer programmer, so he could be heading for an AI dystopian view if all he did was program. But good news, you need other skills that are augmented by AI and are not going to replace the work that's being done. A lot of computer programming can be done via AI, but as a business analyst that sits between the programmers and the business folks, you need people skills that can't be automated. And in fact, that kind of a role will be augmented by and take you to an AI Goldilocks. Financial advisors appear to be, there's a lot of, it's low automation. You can't automate what consultants and advisors do with clients every single day, but you can automate some of the tasks. And it's this framework that makes a lot of sense to me in terms of trying to figure out what can be automated. Electricians, there's nothing you can do to automate being an electrician. Nurses are kind of in the middle here. So I think this is, pretty good way to think about what AI's actual implications are for various jobs and industries. So that's AI productivity and augmentation versus automation. The other, that's on the right side of the scale. Back to the left side, the headwinds. You've got this debt to GDP, this debt mountain. It's higher than it's been since World War II. The CBO just put out another estimate of our 10-year debt trajectory. It's worse than before by a couple of trillion. These numbers need to be addressed. And one of these days, it'll be beyond just sovereign analysts and economists, and the politicians are going to have to do something about it. But what it means is you have to basically, I don't want to use the word realign, I guess, the mandatory social safety net. So Social Security and Medicare are 2/3 of the government's budget. That's where the gains will be. That's where Reform is required in order to bend this trajectory downward. But 140, we're headed to higher than that now. It's 150 now with the new projection. It's just not sustainable, except if we do a couple of things, and I'll talk about those in a sec. It's not all bad news, but here's the bad news. As you increase the size of your debt, and frankly, as interest rates rise, which they've doubled, the average coupon payment on U.S. Treasury debt has doubled in the last 5 years, interest expense becomes greater than defense spending as a percentage of total tax revenue. So defense spending has been about a quarter of the budget, but now it's closer to 18%. This goes back, 40 years. Whereas interest expense used to average about 12 or 13%. Now it's closer to 20. So, and here's a snapshot of what's happened in the last 5 years. So interest expense as a percentage of the budget of total tax revenue is the way to think about it, is now almost 20%, and it surpasses defense spending. Neil Ferguson, an economist, said, and I've said it on this webinar before, great powers that spend more on interest expense than on military spending are very rarely great powers for long. This will revert. We will either start spending more on military, or we'll figure out a way to suppress or financially repress interest costs here, allow inflation to bend this downward. If you let inflation run hot, this is debt to GDP. It's debt over GDP. If you let nominal inflation run hot, the denominator of that construction, the GDP component, tends to increase faster than the debt, and as a result, you get a move closer back down to where we need to be, which is probably below 100% sometime in the next 5 or 10 years. Nothing is sending us in that direction. Again, in terms of economy-wide debt to GDP, we've gone from 48% back 30 years ago now to 230%, and the biggest increase has been in federal government debt. That's the orange bar here. There's also been some household debt increase. At least there was in the early part of the century, and now recently a little more increase. Here's the growth rate, the year-over-year growth rate in total debt. That number has to be about GDP or nominal GDP or below. Preferably, when you see an economy that grows its debt faster than its GDP, that's bad. That means you're on an explosive debt trajectory, and you need to figure out what needs to be done to get back to debt sustainability. I want to turn to demographics and just show you 2 charts. This is the population pyramid. So you've got ages and percentages of the U.S. population. Men on the left, women on the right. If you've got a nice foundation here where you've got folks moving through, but it looks more like a triangle, a regular triangle, or pointed up, you're in good shape. That's a good foundation. Whereas China is kind of the opposite. China's got a very poor population pyramid. You've got kind of the one-child policy, which hollowed out the 40s and 50s here. And there's a bunch of other things that just culturally that keep China on a very bad population or demographic trajectory, whereas ours isn't that bad. If you looked at emerging markets, it's actually a much more condensed triangle where you've got a lot of young folks. But anyway, this is important to highlight. Here's what the potential increase in GDP from AI is likely to be. Tech industries are making up outsized contributions now to GDP. This is the 10-year period ended 94. The 10-year period ended 2004, 2014, 2024. And year to date, this is all of 2025 through September. So what are these contributions to GDP growth? Well, GDP growth, for example, in this period here was 2 to 3 or 4%, 2 to 3%. So 0.5% of it came in this 10-year period. 0.5% of it came from what I would call AI-related, tech-related contributions to GDP growth. One of the things you'll note is that high-tech manufacturing has been, this is orange, used to be a big deal, but that's kind of all getting offshored. Whereas the contributors to GDP growth now are computer system design services and data processing and internet services. These are likely to continue to grow. And software is getting whacked. We'll take a look at that. We have taken a look at that, take a little more look at that. But in terms of contributing to GDP, this is where the rubber meets the road. These are the industries or the subcategories that are leading because of the AI-led investments that we've seen in the last 3 to 5 years. So it's important to note there is a contribution not just from the build-out, but we're expecting a contribution to GDP from total factor productivity too. Speaking of total factor productivity, Here's non-farm productivity cyclically going back to the 50s. You can see that you've got a period of the golden age of productivity was here, where productivity averaged 2.6. Then you have this kind of stagflation, a little bit of a tech boom, but over the last 40 years, productivity growth has averaged about 2%. But recently, this is a surge in productivity we've seen in the last couple of quarters, where productivity growth has averaged 2.5%, well above the 20 or 30-year average here. And the 10-year average is actually approaching, coming off some lows here. So there does appear to be already some evidence to suggest that productivity growth is improving, and I think that's a real net positive. Remember, in our scale, the AI has to be big to offset those headwinds from demographics, deglobalization, and debt. Another way to look at rolling, this is productivity growth, again, golden age, stagflation, tech boom, and then what Larry Summers at Harvard called secular stagnation. Productivity growth was well below the 10-year trend on a cyclical basis throughout most of the 2010s. It's still, again, this is a 10-year rolling. It's still below, but it's moving in the right direction, and you should expect this to go above and become contributory going forward. The key to increasing standards of living is increased productivity. Total factor productivity is the holy grail of economics. So there's a lot riding on AI, moving from promise to delivery in terms of productivity gains, and it's why we're spending a lot of time on it, talking about it today. Here's something that maybe brings this productivity gain home. You've got GDP contributions from professional services and the number of folks that are actually delivering that contribution to GDP. And what you note is that once ChatGPT was produced, professional services include law, financial services, accounting, et cetera. Professional services employment has rolled over, whereas the GDP contribution has continued to increase. And you can see that while there was a significant hiring here to get the employment numbers up to 22.78, it's not a big number. This is a couple of million folks that are you're rolling over, but the contribution is increasing while the employment level is declining. There's no better way to define productivity growth than that, and it's happening in professional services, tech, legal, finance, and it's accelerated since the introduction of ChatGPT. Couple of things. AI, there's been some questions about who's financing who and is it all interconnected? The answer is yes. To try to put some sense on this, there's a group of AI enablers, AI adopters, and AI that's disrupting. These are the software companies primarily. Over here, the AI adopters are Meta, Tesla, JP Morgan, Johnson & Johnson, ExxonMobil. These are the folks that are going to benefit by applying AI to augment tasks, to improve productivity, et cetera. These are the folks that are building basically the railroad. And these are the folks that are getting on the train. And these are the folks that are getting run over by the train. I think is probably the way to describe it. So it's good to know like who's who in the ecosystem. And here's a pretty good slide. This will be available if anybody wants it. I'm going to skip that one for now and just go right to what's happening in AI. So now we kind of set the framework, but how do you invest in it? What do you do? And the answer is you have a broadly diversified portfolio that has exposure to the S&P 500, because if you can't pick the winners and losers, you best get on the train, and the big train, the long train, the longer term horizon train is having exposure to US equities and having exposures to international equities when valuations dictate. But having a broad equity exposure, you're going to get the benefits of AI. You don't have to pick out of all of these companies who are the winners and losers. You don't have to. Just get a broadly diversified portfolio. By the way, how have Apple, Google, Microsoft, Amazon, NVIDIA done? NVIDIA's been crushing it. This is 2024, 2025, and year-to-date 2026. Just to note, in 2026 year-to-date, the S&P is up 1.5% through day before yesterday, whereas an equal weight portfolio is up 6%. That tells you growth is because big cap tech dominates the S&P 500. So growth stocks are underperforming value is another way to look at it. Microsoft and Amazon and Tesla to a lesser extent have gotten whacked. But look at these performance. I mean, I can't tell you. I mean, 2024, 2025, a couple of years in a row, Google up 36 and 66%, Nvidia up 170, then 40. These companies account for the vast majority of the S&P market weight return. And again, the market's still trying to figure out who's going to win and who the winners and losers are in this configuration. If you look back 3 years, if you look at the Mag 7, it's up 3 times, whereas the S&P is up a very healthy 77%. So if you had put your money all in the Mag 7, yes, you would have done much better, but it would have been a very volatile ride. And in fact, it's very challenging as an investor to try and allocate more assets to an index or to a group of assets within an index when there's such a high concentration of the S&P. For example, this is the Mag 7 weight in the S&P 500. Back in 2015, it was 12%. Now it was as high as 35, but with the recent sell-off since beginning of the year in 2026, it's down to 1/3. 1/3 of the market value of the S&P 500 are these 7 stocks. That's astonishing, and it makes it very hard for an active manager to try to invest in this kind of a market, especially considering what has happened to valuations. I want to talk about valuations and then the drivers of valuations, and then get to some more portfolio-related items. So here's price to earnings. So PE ratio of the S&P 500, 26 times. If you look at the equal weight, which is, takes out the effect of Meta, Nvidia, these Apple, Tesla, which has a PE ratio of 200 times, crazy. Apple's at 31, Google's at 26. So obviously the Mag 7 skews the S&P 500's price to earnings or price to sales ratios, whereas the equal weight kind of smooths that out. This tells you value stocks are a little cheaper than the Mag 7, but it isn't. What did we talk about at the very front end? Valuations relate to corporate profits and the growth of EBITDA or corporate profits. Look at the Microsoft, Amazon, Google, Meta, Nvidia. This is the year-over-year growth rate of their 12-month EBITDA. These numbers are astonishing. If you can grow EBITDA like a year and a half ago, now almost 2 years ago, EBITDA was growing at these 5 companies at 50% annualized growth rate. Now 25. That's huge. A 25% annual growth rate of EBITDA. Well, by golly, maybe these valuations and some of these PE ratios, you can grow your way out of them. Remember, price to earnings is price on the top, earnings on the bottom. If you grow the denominator, earnings, fast, it deflates your PE or your valuation metrics to something more normalized. It doesn't look horrible. I mean, these look very, very rich, but they're not rich in the context of their earnings growth potential. I think that's important. Unfortunately, a lot of the EBITDA is going into CapEx. So what you care about in some respects is cash flow. So let's think about what's happening here. You've got these companies that are printing money, but then they're turning right around and reinvesting it in data centers and other infrastructure in this mad rush of AI build out. So while it's important to see that these numbers are growing, EBITDA is growing at a very fast rate, it's impossible to maintain a 74% growth rate in CapEx if your EBITDA is only growing at 25%. How do you fill the gap? Got to start borrowing money. And in fact, what we've seen in terms of big tech long-term debt growth, Oracle's up 50% in the last 3 years. Long-term debt's grown from 75 billion to 116. Amazon long-term debt, not so much. They're not involved in the race as much as others maybe. Microsoft, big move up. Meta's doubled their debt. Google has gone from 26 billion to 80 billion in the last, and 30 of it came 3 days ago. One component of this increase, this $31 billion increase in the long-term debt at Google, was a century bond, a 100-year bond, denominated in sterling, 100 years at a yield. I got to find the coupon, but it's 120 basis points over sterling rates. So call it a 5% coupon. It's probably 5.5, but very low coupon for 100 years. You're going to get paid pound sterling, 5+% for 100 years for a company that may or may not be there 100 years from now. Issuing 100-year debt is very rare, and it's a sign of massive demand, maybe maniacal demand, I don't know, for debt for some of these companies. Julian, did you have a question?
No, just a quick time check. We have 20 minutes left and still a lot to cover. Let's talk about the Fed. And I guess January was busy with the subpoena and the new Fed chair nominee. A lot of questions about the independence of the Fed. Where are we?
Let's talk about it. I think we're going to be okay. I was more worried 6 months ago when you had the startling announcements related to primarily Lisa Cook, the public torture of Jay Powell, and the recent the indictment in January, or the threatened indictment in January from the federal prosecutor in the Southern District of Manhattan. To me, all of that is pressure. It's a pressure campaign to capture the Fed and force policymakers to push interest rates lower. It's not going to work. I thought it might, and it may. We still don't have a decision from the Supreme Court on Lisa Cook, but we're finally seeing some pushback from Congress on some of the things that the administration wants to do in terms of removing or pressuring voting members of the Fed. That's the FOMC, or the Federal Open Market Committee, and includes all the Fed governors and a rotating cast of the Fed regional bank presidents. Here's it was a good thing for the markets that Kevin Warsh was nominated. He's made comments, and now he's been off the Fed since 2011, but he's participatory in the markets. He's been a longtime critic of expanded balance sheets. Unfortunately, that's exactly what I think the president needs, is somebody that wants to expand the balance sheet. I'll elaborate on that in a sec. No, I'll elaborate right now. Expanding the balance sheet means lowering 10-year yields. The Fed has control of the short-term interest rate directly, the federal funds rate. They set that directly. However, if you want to get long-term interest rates down, you have to do quantitative easing. You have to or reestablish a large-scale asset purchase program, or LSAP. The large-scale asset purchase program that was implemented, we called it QE, 4 or 5 iterations in the 2010s, caused longer-term yields to decline because the Fed was printing money and then buying 10-year notes. That demand caused interest rates to come down. That's what the president would like. Warsh has been on the record as stating he doesn't think that's a good idea, and that the interest rate should be the primary tool, not the balance sheet. So we'll see how that happens. Again, I was speaking to a Fed official earlier this week about this, one of the Fed governors, and his view is that it's going to be very difficult to reconcile Kevin Warsh's previous comments with what the administration wants him to do. And I think the phrase was, it's going to be a dance. So it'll be very interesting. Warsh has been nominated, and here's where I think credibility is likely to be retained. Tom Tillis, Senator Tom Tillis, who's on the Senate Banking Committee, and by the way, there's a total of 24 members of the Senate Banking Committee, 13 Republicans, 11 Democrats. All you need is one Senate Republican on the Senate Banking Committee to say, I'm not going to vote for your nominee, and now it's 12-12 deadlock, and your nominee will not be brought to the floor of the Senate for debate and for vote. So the point is, when Tom Tillis said, and he did on January 9th, very clear on January 11th, right after Jay Powell was threatened with the indictment, he said, we're not going to do anything with any nominee until this is cleared up. So Scott Bessent, the Secretary of the Treasury, met with Republicans in a closed-door meeting yesterday, and the discussion related to this, the Department of Justice dropping the inquiry or the investigation of Jay Powell and moving the investigation into the Senate Banking Committee's purview, where Tillis sits. I doubt he'll accept it, actually. I don't think it's going to happen. I think if the president wants Kevin Warsh or any other nominee to be approved, and Kevin should be approved, he's a great candidate. If the administration wants it to be done, they're going to have to make this Jay Powell thing go away, and that will preserve Fed independence. And in any event, you can check on the credibility of the Fed by looking at something called 5-year forward break-even rates. This is the metric that measures Fed credibility, and it's heightened. It's at I would call it flashing yellow. But over longer periods of time, this metric should be around 2%. This is not. So let's jump into one more item on the Fed. Then we should probably talk about alternatives and maybe some of the headlines related to private credit. So Fed independence is essential. This is the framework. No one person dominates. In fact, the Fed chairman only gets one vote too. So just to be clear, there's 12 voting members of the FOMC, 7 governors, 4 rotating. no matter who you are, even if you're the most powerful Fed chairman ever, which is probably Paul Volcker, maybe Alan Greenspan, but certainly these folks, you still get one vote. I'm going to talk about what the Fed's going to do this year really quickly. The market says 1 or 2 rate cuts. The first rate cut now July, not June. And over the next year, a max of 2. That takes us to R star normalized interest rates. Again, we talked about the balance sheet being a tool of the Federal Reserve. When you have quantitative easing, it's increasing the balance sheet. That happened here, peaked at 9 trillion. I don't think there's much to do there. If the administration is going to have to convince a plurality on the FOMC to start up quantitative easing, to lower 10-year yields, which, by the way, would have the very salutary effect of lowering mortgage rates. The FOMC doesn't control mortgage rates directly. They control the short-term interest rate, but all mortgages are long-term. So the Fed needs, no, the administration needs 10-year yields to come down to reduce mortgage rates. That would require quantitative easing. I don't see it happening. Let's look at this. Oh, very good. So I want to talk about the consumer and then a private credit. So the consumer, and we're going to get through private consumer pretty quick because private credit's been in the headlines. The consumer is doing just fine if you have assets. This is the S&P 500. It's moving up. But if you don't have assets, you're pretty down on the environment. So consumer sentiment is negative. That's a problem. That's what we're seeing here. That's the K-shape. Asset owners are feeling good. The vast majority of folks that respond to the consumer sentiment survey have participated less in house price increase and S&P, and it's not happening. So consumer sentiment is depressed. This is future expectations, very low, but they shouldn't be. People shouldn't be that depressed, except this is a narrow slice of the pie. This is household net worth. It's at record levels and above trend, but still, it does. Not everyone's participating. It's like looking at averages instead of the median. The median would tell you more that maybe more people should be depressed. This is net worth to liabilities. So people have 9 times the assets on their balance sheet than the liabilities. Should be, again, who has those assets? Answer, it's the upper strata of the socioeconomic spectrum. Here's a worrying component. You may not have assets, but you probably have debt. So debt defaults are increasing. So overall, all U.S. loans that are in delinquency, it's currently at the highest level since 2017. So we haven't seen levels like 4.8. So there's some cracks in the consumer, but they're at the lower end of the spectrum. Why does affordability seem like a problem? Answer, because during COVID, the 5-year average of CPI doubled from 2 to 4.5. Let's go to portfolio with a focus. Okay, Julian, you have your hand up.
Yes, there's a lot of questions on portfolio positioning. And before we go into alternatives and do a deep dive, can you maybe summarize quickly how we feel about equities, US, international, gross value, and fixed income, and including municipal bonds? We had a few questions on that.
Yeah, for sure. I mean, here's the summary, which could be the capstone, but I'll come back to it. I'll cover it now because it's important to get to the conclusions. Value and quality in the US are likely to outperform. Large cap likely to outperform small and mid, but less so. There seems to be a broadening out of the in the equity markets from just what was primarily a concentrated big tech rally, and big tech has done really well, but the benefits seem to be trickling down. That's our view. So we've actually added back a little bit to mid cap and small cap, but still feel pretty strongly about these large cap tech companies, but the conversation is changing to a broadening. In terms of US versus non-US, it goes back to the US dollar. If there's pressure on the US dollar, you should maintain exposure outside. Valuation metrics dictate that international equities are cheaper versus the US. In terms of interest rates, the Fed's near normalized, but long-term yields are likely to remain elevated unless you get a quantitative easing policy mix, which seems very unlikely in the current environment. But alternative investments is where things are happening. And I just want to cover broadly alternatives and why you would include them in a portfolio and look at maybe recent performance versus long-term performance. It's unequivocally positive to add uncorrelated assets to a portfolio that have a positive expected return. Stephen Marshall, our head of asset allocation, I think has that tattooed on his arm. If you add alternatives to a 60-40, you move up in return and lower to the left, which means less risk. A portfolio that moves up and to the left is desirable on the efficient frontier. It shifts the entire efficient frontier up and out. So alternatives have historically been unambiguously positive because they have lower volatility and higher expected return. So 70-60-40, if you add 20% alts, your expected return goes from 7 to 8, your expected risk goes from 10 to 9. That's big. That is the holy grail of investing, moving up and to the left. An 80-20 to 60-20-20, pretty meaningful move. So adding alternatives is good historically. And here's the numbers. I mean, if you looked at asset class returns, private equity versus public equity, I'm just going to highlight those two numbers. 2,000% return on private equity in the last 25 years, 500% or 600% return on public. So there's been a substantial benefit to being in private assets versus public assets. Same goes for private credit, up 900% versus public fixed income, up 22%. It's off the charts. Now you're taking more risk in private credit than in treasury bonds, which is a big component of public, but those are the numbers. If you're looking at a 60-40 portfolio versus a 50-30-20, volatility is dampened. Even in the last 3 years, when a 60-40 has actually outperformed, in the last 3 years, a 60-40 has outperformed a 50-30-20. Over 25 years, it has not. But even with the outperformance of a portfolio that includes private alts versus one that only has public, you've still got a significant component of volatility dampening. And that's the most important thing when you're looking at performance. You have to look at it risk adjusted. So including alternatives, 20% alts in a 60-40 has dampened the volatility of the portfolio, but it has not improved your return versus public markets because in the last 3 years, actually 4 years, looking at 2020, in the last 4 years, actually, in 2022, a portfolio with alts significantly outperformed on the downside, as you would expect. That's when portfolios with alts, private alts in particular, shine, is in the downturns. So you've got a downturn here. In 2022, a 60-40 was down 16%. If you had alts in the portfolio, you're only down 12. But over the last 3 years, a portfolio with alts has underperformed a portfolio that only had public equities. But if you look at portfolio returns with and without alts, since 2002, 500% versus 380% cumulative return. So I just want to highlight the fact that having alts in the portfolio is a very good thing. Now I'm going to make some comments about private credit. Private credit has been in the headlines a lot in the last 6 to 9 months. Our view on private credit, especially, by the way, private credit is not homogeneous. Private credit is direct lending to middle market, direct lending to broadly syndicated loans. So there's a lot of corporate direct lending features, small companies, medium-sized companies, and big companies. Private credit also includes asset-backed financing. It includes specialty financing, so things like royalties, funding, financing art, financing maritime, leases on boats, barges that go up and down the Mississippi. There's specialty. There's a lot of pockets of the U.S. economy that get funded through private credit that aren't directly related to what I would call corporate direct lending to middle market companies. There's also, beyond asset backs and other things, there's other ways to diversify your private credit exposure into real estate finance and or infrastructure. Our view has been, it's been a great place to be for the last 10 years, and our clients have benefited dramatically from exposures to direct lending. Direct lending spreads have compressed because of the demand for it, and like any other asset class, our view remains. We need to evaluate whether or not you're being compensated for the risks you're taking and to allocate assets to those asset classes where compensation for risk taking is rewarded and to allocate away when compensation for risk taking is compressed. Compensation for risk taking in private credit direct lending is compressed. Compensation for risk taking in asset-backed financing is not compressed to the same degree. So our view has been in private credit, knowing that it's heterogeneous, there's a bunch of different private credit buckets, moving away a little bit, a slight diversification, not a wholesale revulsion of private credit, because quite frankly, the headlines don't tell you the whole story. I've been managing credit portfolios for 30 years. Here's the most important thing. Where are you in the capital structure? That is, what's the credit quality of your asset? How much diversification do you have both in terms of credits and in industries? And we'll talk about software for a second. and how much leverage do you take at both the company level and at the fund level. If you can assess those three things across different products and different managers, then you can pick the right ones. Right now, in many cases, the baby's getting thrown out with the bathwater. There's a lot of headlines, and there will be a time when private credit isn't as favored as it is today. And that will mean a spread widening, folks reallocating away from private credit, a sell, call it private credit will be a sell. It's a hold right now for some. For us, it's a diversification decision, but we remain confident that for the most part, especially the high quality managers that Beacon Point has selected for our for our clients, both private and institutional, that those managers will weather the storm because they have high quality, senior secured as opposed to subordinated debt primarily, low leverage, highly diversified, 3,000 loans in a portfolio, for example, in one of our larger managers. These are the keys to credit investing. Will you get it right every single time? No. Will you see 7 or 8 or 9% returns in private credit forever? Absolutely not. One of these days, private credit is going to have a reversal, but the spread or the compensation for risk taking remains meaningful. Is it a screaming buy like it was 3 to 5 years ago? No. Is it a sell? No. So try to ignore the headlines a little bit because they don't tell the whole story. They're picking things like a large asset manager's BDC or business development company that had a 20% write down and extrapolating the assets that were in that fund, some of which were software, and tattooing the entire industry with it. I don't think that's right. That's not how we manage money. You don't throw the baby out with the bathwater. Julian.
Anything else on alts, or shall we talk about how to be positioned after 3 years of bull market and plus 100% in the S&P?
I think it's a great question, and I'll go back to the slide we presented, or that I would have presented up front, which is overall risk taking. We're risk on still. If you do the balancing between the headwinds and the tailwinds, it still looks like we're not going to have a recession in the next 2 quarters. As long as you don't think we're going to have a recession, it's probably okay, or the markets don't believe you're going to have a recession. It's probably a-okay to have some risk on. So we actually have, I would say, 60 or 70% of our risk budget on right now. And that's because our cyclical outlook is for late cycle resilience. It's for resilience in the economy and resilience in corporate profits and a steady state, not a Fed rate hiking cycle. If you thought corporate profits or the economy was going to roll over, or if you thought the Fed was going to raise interest rates, either one of those would argue for reducing risk, but we don't see that right now. Our equity market risk is primarily in large cap core and large cap value, and to a lesser extent now in international. We're underweight US mid cap, but less underweight than we were before because we were pursuing a thesis of a broadening of the equity market rally over coming quarters as the benefits, the productivity benefits of AI continue to diffuse throughout the economy. Now, if you're risk on, you have to fund it from something. You have to sell something. So we're underweight bonds. We're underweight bonds for 2 reasons. One, because we need to fund the equity overweight. And 2, there's not a catalyst for long-term interest rates to come down. That's why you would want to be overweight bonds if you thought long-term interest rates were coming down. Even if the Fed lowers interest rates, it's likely that the curve will continue to what we call steepen, and that would leave longer rates kind of intact. So you can clip the coupon and expect a return of about 4% on bonds this year. But if the expected returns for stocks are 6, 7, 8% for the year, that's a reasonable estimate, I would guess. At least in the first half, we're thinking 7, 8%. Maybe in the second half, maybe lower, maybe a deceleration. But no matter what you do, having an allocation to alternatives, as I hope I've conveyed to this group, is very beneficial. Reducing risk, increasing expected return equals a more optimal portfolio, and that's how we view the world today. Any other questions that we want to take before we wrap up the call today, Nick or Julian? Not seeing any. Let's close the call, and I want to thank all of our clients and all those that have tuned in today for spending some time with us to talk about macro and markets. The investments team, particularly Nick and Julian, for preparing the presentation today. Thank you again, and I look forward to speaking with you all very soon. Yeah. Take care. Bye now.
Thank you, Michael, and thank you, Nick, for answering so many questions, and thank you all for joining. So we'll have our next quarterly update on May 14. Please keep an eye on your inbox for an invite. We look forward to seeing you then. À bientôt. Merci.